I took 15 of the most popular day trading methods and broke them down. 9 of them will actively destroy your account, and I bet you use them often. Let me show you the only 5 mechanics you actually need to build a real edge, starting with the biggest beginner trap of all, support and resistance. Here's the trade. Support level, 4 touches, textbook buy on the 5th. Stopped out in under a minute, $600 gone. Every single touch consumes the buy orders sitting at that level. First touch, there's a wall of orders, hard bounce. Second touch, fewer orders, smaller bounce. Think of it like walking on ice. First person crosses fine. Second person, cracks form underneath, but the surface still looks solid. By the 5th crossing, the ice gives way. It never looked weak until it broke. Institutions know exactly where every retail buy order is sitting. By the 4th touch, they're not buying support alongside you. They're loading shorts into your long entry. You thought you were buying strength. You were buying their exit. More than 3 touches on a level. I'm not buying it. I'm watching it break and fading the move. Protect your capital. Lock in the free trade. Your break-even price is a number that matters to exactly one person in this entire market, you. The market has no idea where you entered. It doesn't care. Normal trends retrace. That's what healthy trends do. When they retrace to your entry, which is structurally meaningless, your stop gets taken. Then price continues exactly where you thought it was going. Right direction, right trade. You're watching from the sidelines. New rule, trail your stop to a level that makes structural sense. Something the market cares about, not just you. The first pullback, the thing every course tells you to buy. Sounds basic, sounds like something that shouldn't still work, except it does. And the reason isn't what you'd expect. After a real trend change, the first pullback is exceptional. The trend is fresh. Trapped traders from the old trend are still being forced out. That is the pullback. You're not buying weakness. You're buying the exit pressure of everyone who was wrong. By the third pullback, you're late. More participants positioned. The move closer to exhaustion. In a confirmed new trend, the first pullback is where you size up. Every pullback after that, you reduce. 3 signals lining up. The indicator agreeing with the pattern, agreeing with the candle, agreeing with your gut, agreeing with Mercury being in retrograde. Watch this. Same setup, same direction, but 3 different entries. Entry at the level reaction, 4R. 1 confirmation later, 2.5R. 3 confirmations in, barely 1R. Every confirmation you wait for is price moving away from your stop and toward your target. You're not reducing risk, you're compressing your reward while keeping the exact same directional bet. Here's the new rule. If the level is right and the reaction is there, that is your confirmation. Everything after that is just fear with extra steps. Volume weighted average price. It's a line. It's a moving average in a suit. This should be an easy one to destroy, except I couldn't. Institutional funds are literally benchmarked against VWAP. Their execution algorithms are contractually designed to transact around it. First touch from below, bounce. Second test, holds. Real institutional mechanics, real reactions, real edge. On intraday equity charts, VWAP is the most reliable reference level on your screen. Keep it there. Okay, 3 busted, 2 confirmed. But this next one, the signal most traders trust to catch reversals, has been lying to them for years. Price makes a new high. Indicator makes a lower high. Reversal incoming. I held a short for 3 weeks because the divergence was clear as day. Technically correct. Losing money the entire time. My account didn't care that I was right about momentum. Divergence tells you one thing: momentum is slowing. A car going 100 miles per hour, slowing to 80 miles per hour, is still going 80 miles per hour. It will run you over just fine. Divergence is a yellow flag on the motorway, not a red light. The engine is getting tired. That does not mean the car is stopping. Treat it as context, never as a trigger. Head and shoulders reverse because the crowd loses confidence. Double bottom forms because buyers step in twice. Wrong mechanism entirely. Patterns work when they work because of where the stops are sitting. Below that neckline, there's a pool of stop losses from every trader who bought the right shoulder. Institutions drive price through that pool to fill their own entries. The pattern is just a visual map of where liquidity has accumulated. When the liquidity isn't there, the pattern fails. Doesn't matter how perfect it looks. Before you trade any pattern, find where the stops are, not what the shape looks like. So what do you actually use to catch reversals? This next one measures something real. Delta divergence. Sounds like another indicator, except this one isn't measuring a formula applied to price. It's measuring what actual traders are doing with real money in real time. Are more people aggressively hitting buy or aggressively hitting sell right now? That's all it measures. When price pushes to a new high, but fewer contracts are being aggressively bought, at the ask with each push, the fuel is running out. Not mathematically. Real market participants are pulling back. A delta divergence measures what actual traders are doing with real orders in real time. Look, 3 pushes higher. Delta declining at each one. Hard reversal. That's not an indicator. That's order flow. Declining delta on a new high. I'm preparing for reversal. No exceptions. Price sweeps a high. Short it. Reversal incoming. The smart money playbook. Look at this. Clean sweep. Textbook entry. Price pauses 3 candles, then continues higher and stops you out. A sweep fills orders. But what orders? If institutions swept that high to enter longs, not exit them, the move isn't reversing. It's launching. You just shorted their entry. A sweep tells you orders were taken. The higher time frame trend tells you the direction, not the sweep. Never just the sweep. That's the correct rule. Now, the next one, the most boring, basic, obvious piece of advice in all of trading, actually holds up. Trade with the trend. The most basic, overused, fortune cookie advice in all of trading. Surely there's nothing here. But when the weekly is trending up, institutional capital is flowing in that direction. Their algorithms are accumulating. Counter-trend trades on lower timeframes can work as quick scalps. But statistically, you are swimming against a river. Same setup, 2 trend contexts, completely different results. The higher time frame is the current. You don't predict it. You don't fight it. You get in it and ride. This next one, I expected to destroy it, but the answer is more complicated than that. The golden ratio embedded in price movement, nature's math reflected in human behavior. Sounds beautiful. Fibonacci levels work sometimes because enough traders watch them that orders cluster there temporarily. Self-fulfilling prophecy, not mathematics. And when they fail, well, it went to the 78% instead. You can always find a Fibonacci level near a reversal if you scroll through enough of them. That's not analysis, that's hindsight with a measuring tool. And here's why I can't fully destroy this. When a Fib level lines up with a structural level that already exists, the confluence does create a denser cluster of orders, not because of the golden ratio, because 2 groups of traders are watching the same price for different reasons. Fib level at your area of interest. Fine. Extra context. Fib level with no structural reason to be there. Ignore it. Not everything is black and white, but this one is. Pull up any chart. Draw your support and resistance levels. Now draw supply and demand zones on the same price action. Same areas every single time. The terminology changed. The zones got wider. The explanations got more institutional sounding. The mechanic is identical. You're marking where price reversed before and expecting a reaction when it comes back. The name doesn't make it work. The quality of the level does. Patience, discipline, confirmation. I waited 45 minutes for an hourly candle to close on a perfect setup. Watched price move 30 points while I sat there being disciplined. Entry at the level reaction, stop 10 points, target 50. That's a 5R trade. Entry at candle close, stop 22 points, target 38. That's 1.7R. Same trade. You gave away 3.3R for a feeling of security that was completely imaginary. Please remember this. The reaction at the level is the signal. By the time the candle closes, you've confirmed what you already knew. You just paid more for it. Now, this next one, most traders have never even heard of it. The point of control, where the most volume traded in a given period. Sounds niche. Sounds like something someone made up to sell a course on volume profile. But institutional execution is designed to transact near fair value. That's where the liquidity exists to fill large orders without moving price against themselves. The point of control is that fair value, by definition. It's not an interpretation. It's a measurement of where the most business actually got done. Yesterday's POC, clean reaction in today's session. Naked POC from several days ago that hasn't been tested. Price reaches it. Hard reaction. Every naked POC on your chart is a magnet. When price approaches one, I watch for the reaction and act on it. Stay on the daily. The 1-minute chart is for gamblers. This daily pin bar looks clean. Bullish reversal. But where do you enter? Where's your stop? The candle is 80 points tall. Well, zoom in. On the 5-minute, there's a sweep of the low, absorption, and a clean reversal sequence. That told you exactly where to enter with a tight stop. The daily chart hid every useful piece of information inside one candle. What looks like noise on lower timeframes is the trade. Institutional execution happens on lower timeframes. Higher timeframes give you direction. Lower timeframes give you precision. You need both. So 9 out of 15. More than half of what you've been taught is either wrong or will actively lose you money. The 5 that survived, they survived because they're backed by real mechanics. But here's the problem. Knowing what works isn't the same as knowing how to read it live. I break down the exact structure I look for right here. And this is exactly the kind of setup we break down inside our academy. See you inside.